Nvidia delivers, but does good no longer cut it? Expectations for Nvidia have become almost impossible to meet. After 14 straight quarters of eye-watering revenue beats, even another strong set of earnings wasn't enough to wow investors. Markets are hungry for the next surge in AI-driven growth, and the chipmaker that helped ignite the boom is now facing tougher scrutiny. Aoifinn Devitt is Senior Investment Advisor at Moneta. What really stands out to you in these numbers?
Say it's certainly reassuring to see these numbers, but based on the fact that they are backward-looking, and we do know just how extraordinary the CapEx increased spending had been across the board by hyperscalers. So there's not really a great surprise in seeing the increase in CapEx spending and it flowing through to Nvidia numbers. I suppose what is surprising to see is that they continue to hold a pole position here, that there isn't a great deal of competition. They certainly have that first mover advantage. But we are receiving these numbers now with the sentiment as mixed as it is, and that's possibly why we're seeing the mixed response.
Well, investors wanted evidence that AI demand isn't peaking. Does this report build durability confidence?
Well, certainly we know that AI demand has been strong and that the expenditure to date has already flown through into these numbers. I'd say where the concern is regarding the demand picture and whether this excess CapEx, which in the past had been rewarded, is now being punished essentially or not being given the benefit of the doubt. There was this suggestion during the week of AI washing, suggesting that maybe it was AI was to blame for some cuts that are happening when there hasn't been a direct link yet drawn between the headcount cuts and AI replacement. So I think there really is a muddle of piece of information right now that investors are trying to sift through. And that is why it's not a durable picture.
One other concern hanging over the sector is supply, particularly memory and broader chip constraints. Nvidia pushed back on those fears, but how real is this risk?
Well, that has been certainly the constraint that many AI firms have suggested. We know that data centers have started to receive some populist pushback. We know that the demand for energy has been very sustained. And there have been frictions there within communities and just generally with competing sources of supply. So I would say that is continues to be a concern and a constraint. But likewise, from the demand side, will all of this demand be needed?
Well, Nvidia pointed to megadeals as proof that spending remains strong. But when demand is concentrated among a handful of giants, is that sustainable?
Well, I would say this is really interesting to focus on those megadeals. When many of these deals were inked, but not actually very well developed in terms of detail or actual legal commitments. And so all it takes is a rumor in a financial piece of news to suggest that perhaps the deal between Nvidia and OpenAI or other counterparties is not going to go ahead as planned or was perhaps not rich enough in the detail, that can then send a cascade of concern through those stocks. So I'd say relying on mega deals, many of which were set based on metrics in the future, is quite a dangerous level of assurance to give at this time.
Nvidia as well excluded China AI chip revenue from its outlook, leaving out potentially billions in upside. How much of a structural overhang are geopolitics now?
Another great question there. We do know we've had a very ebullient State of the Union address just this week by President Trump. We know that he has come out swinging when it comes to trade, and he's not backing down despite the Supreme Court decision. So I'd say that is going to be very much in the crosshairs going forward. We also haven't mentioned the incursion into some of these proprietary models by Chinese developers. But that is another big risk that's sitting out there. We did see Anthropic get involved in assertions of IP theft, essentially, over the course of the week. So I'd say the global politics around supply is going to be a continuing source of noise and risk here for these stocks.
So finally, Aoifinn, Wall Street is struggling to see the trajectory of AI, worried that the tech is not lucrative enough or too disruptive. How are you navigating this uncertainty?
Well, I think it's probably very salutary that there have been a situation of winners and losers finally. It wasn't that everybody could be a winner in this. There was going to be inevitable losers. We've seen that the SAS software fall by the wayside. We've seen financials, credit cards, our industry, the wealth management industry. There perhaps has been the baby thrown out with the bathwater over the course of the week, but it's very difficult to know whether customer loyalties will prevail over easy substitution, which is what some of these models are supposed to provide. So I'd say a huge amount of uncertainty right now. We're seeing and Goldman Sachs suggesting that it's the capital heavy stocks that are going to likely be sustained. And then on the other hand, we have some bottom fishers suggesting that the software companies have been oversold. So a great time to be a stock picker because there are definitely lots of competing views out there.
That was Aoifinn from Moneta. Don't forget you can watch more videos on Reuters.com.